Hey everyone, and welcome back to Talk Tickers. We're diving deep into Lyft's Q4 2024 earnings call today.
Yeah, should be interesting.
Definitely. Looks like they had a pretty remarkable year.
For sure. First full year of GAAP profitability. That's big.
Huge. Makes me wonder how they pulled it off, right?
Right.
What were the key factors?
Well, seems like driver satisfaction played a big role.
Oh yeah, we saw that 16-point preference gap over their biggest competitor.
Exactly. Drivers are actually choosing to drive with Lyft.
That says something.
Definitely does. They're really investing in driver earnings and support. And it seems to be paying off because they also reported the fastest average ETAs in the industry last quarter.
So faster pickups for riders. That's what we like to hear.
Right. Nobody wants to wait around forever.
Nope. And they've done a lot to reduce surge pricing too, right?
Yeah, prime time, as they call it. Saved riders over $400 million in 2024 alone.
Wow. Price reliability is a big deal for riders. It makes the whole experience so much better.
Absolutely. And they've gone a step further with their price lock feature.
You can lock in a fixed price.
Yep. About 70% of users are using it month after month. It's a popular feature.
Price certainty is a big selling point these days, and they even expanded price lock to 2047 availability.
Smart move. Caters to even more riders.
Makes sense. So we've got happy drivers, happy riders, and a company that's actually profitable. But what about the future? What are their plans?
Well, they're not resting on their laurels, that's for sure. They're actively expanding their reach through partnerships.
Partnerships, like what?
They've teamed up with companies like DoorDash and Delta.
Interesting. So they're branching out.
Exactly. Tapping into new customer segments and diversifying their offerings.
Makes sense. What about autonomous vehicles? Any movement there?
Oh, yeah, they're all over that. Partnering with Mamo Mobility and Marubeni to deploy thousands of AVs on their platform.
Wow. They're really going all in on the future of transportation.
Yeah.
What's their outlook for Q1 2025?
They're projecting mid-teens rides growth and bookings growth of about 10% to 14% year over year.
Sounds promising.
It does. But they've also noted that lower pricing in the market might affect profitability.
So there are challenges ahead.
There are, but they've been pretty good at adapting.
Let's dive into some of the specifics. Starting with financials, what figures stood out to you?
Well, gross bookings for 2024 hit $16.1 billion, a 17% increase year over year.
Wow, that's a big jump.
It is. Shows strong demand for their services.
For sure. And their pricing strategy seems to be working.
Definitely. They consciously reduced surge pricing, putting customer satisfaction first.
It's a long-term play. Build trust and loyalty with riders.
Exactly. And their efficiency goes beyond pricing. They achieved a 17% efficiency in deploying customer incentives per ride.
Meaning they're getting more bang for their buck when it comes to attracting and retaining riders.
Right. They initially aimed for 10% efficiency, so they're exceeding their own goals.
Impressive. And what about fixed costs?
They achieved over 100 basis points of fixed cost leverage for the year. Basically, they're getting more output from their fixed costs like rent and salaries.
Which means
Directly contributes to their profitability.
so it's not just about bringing in more revenue, it's about managing expenses well.
Exactly. And even with rising insurance costs, which are a major expense for these companies, Lyft still managed to improve its unit economics.
Shows they can handle industry challenges and stay financially sound. Now, let's zero in on Q4 performance. What were some key metrics there?
Solid 15% growth in rides and a 10% increase in active riders.
Growth isn't slowing down.
Nope. And their gross bookings for Q4 hit $4.28 billion, another 15% year-over-year increase.
That's with the pricing adjustments they made.
Yep.
And their adjusted EBITDA grew by almost 70% year over year.
It did. They expanded their adjusted EBITDA margin as a percentage of gross bookings from 1.8% in Q4 of the previous year to an impressive 2.6% in Q4 2024.
Getting more profitable each quarter.
For sure. They also achieved another quarter of GAAP profitability and generated a strong free cash flow of $140 million in Q4.
That's a clear sign of financial strength. Now, let's go back to driver satisfaction. We know it's a key differentiator for Lyft, but how are they doing it?
Well, they're committed to fair wages for drivers. They've implemented earnings guarantees and improved their support systems.
They're really putting their money where their mouth is.
Right. And it's not just about the money. They've tackled those frustrating breakout situations too, making sure drivers get paid fairly when rides take longer than expected.
The little things make a difference.
They do. They've also implemented a system where they pay drivers for scheduled rides as soon as they arrive at the pickup location.
So less waiting around.
Exactly. And they've partnered with Merit America to provide drivers with opportunities for skill building and career advancement.
Wow, investing in their drivers' futures.
It is. It's a smart move. And they're also using AI to make support processes more efficient.
Saving drivers time and reducing frustration.
Exactly. It's a win-win. Happy drivers, happy riders, everyone benefits.
Now let's look at the rider experience. Lyft's made impressive progress reducing ETAs. How do they manage that?
Major investments in technology and driver support. They're using sophisticated demand prediction models and incentive systems to ensure drivers are always in the right place at the right time.
So like a well-oiled machine.
Exactly. And they've significantly reduced driver cancellations.
No more phantom cancellations. Those are the worst.
Right. And of course, we have to mention the price lock feature. Knowing the exact cost up front gives riders peace of mind.
Game changer. And it's now available 24/7.
Yep. Lyft's constantly evolving and expanding its offerings.
Speaking of evolving, let's talk about those autonomous vehicles. That's an area where Lyft is really pushing the envelope.
They are. They're partnering with key players in the AV space.
They've already teamed up with Mamo Mobility for AV services in Atlanta. And their partnership with Marubeni will bring thousands of AVs to the Lyft platform, starting with Dallas in 2026.
Those are big moves. They're really shaping the future of transportation.
Ambitious. Now, Lyft isn't just about rides anymore. They're building a whole transportation platform.
Their partnerships with companies like DoorDash and Delta are expanding their reach.
Tell me about the DoorDash partnership.
Well, it's facilitated nearly 8 million rides, giving people a way to get around while they're waiting for their food.
Smart.
And it's a win-win. DoorDash gets reliable transportation, and Lyft gets increased ride volume.
Makes sense. And their Delta partnership.
It's ending in April, but it was successful in connecting air travelers with ground transportation.
Too bad it's ending.
It is.
Yeah.
But it shows Lyft can attract and integrate with major players. Even though that partnership is ending, they've said they're actively seeking new partnerships.
Always looking ahead. What about their media business? That's relatively new for them, right?
It is, but it's growing quickly. Their media platform gives advertisers a way to reach Lyft's massive user base.
And how is it performing?
They ended 2024 with an annualized bookings run rate of $50 million, which is right on target.
Not bad at all. What's the outlook?
They're projecting an annualized bookings run rate of $100 million by the end of 2025.
That's ambitious.
It is, but they've got innovative ad formats like in-app ads and map takeovers.
I've seen those. They're pretty eye-catching.
They are. And they're always innovating, adding new features like full-screen vertical video ads.
Sounds like they're serious about building a solid media business.
They are. It'll bring in more revenue and strengthen their overall financial performance.
Speaking of revenue, let's talk about those higher margin offerings. Lyft's catering to a wide range of riders, right?
They are, and their focus on expanding Black and SUV ride options is a strategic move to increase their average ride value.
Makes sense.
These premium services attract riders who value comfort and are willing to pay a bit more.
Higher price, higher margins for Lyft.
Exactly. And in 2024, Lyft Black and Lyft SUV rides saw a 41% year-over-year growth.
Wow. People want that premium experience.
They do. And Lyft has a three-pronged strategy to drive this growth. First, they've tightened up their vehicle eligibility criteria for Black car riders.
Ensuring a high-quality experience.
Right. Second, they significantly increased the supply of Black car drivers on their platform.
Smart move. No one wants to wait forever for a ride.
And finally, they expanded Black car service to 64 markets across the U.S. and Canada.
Wow. Making it accessible to a much larger audience.
Exactly.
Now, what about their Q1 2025 guidance? How are they planning to handle the changing market conditions?
Well, things are a little more complex now. They're facing headwinds like pricing pressure and losing the Delta partnership.
Okay, let's break that down. First, their projected rides growth.
They're anticipating mid-teens growth in Q1, thanks to their strong market position, loyal riders, and continuous innovation.
Still a healthy growth rate.
It is, but their gross bookings growth is projected to be a little lower, between 10% and 14% year over year.
Because of the lower prices.
Yep. The whole rideshare industry is seeing some downward pressure on pricing.
It's a tough balance.
Yeah.
Stay competitive on price, but protect those margins.
It is. They've said they're projecting gross bookings of around $4.05 billion to $4.2 billion for Q1.
Okay. And what about adjusted EBITDA?
They're expecting $90 million to $95 million, with an adjusted EBITDA margin as a percentage of gross bookings of about 2.2% to 2.3%.
So, still profitable, but those lower prices could squeeze margins.
Exactly. And they've also highlighted the impact of the Delta partnership ending on April 7th. They expect it to affect their rides and gross bookings growth by about 1% and 2%, respectively, starting in Q2 2025.
Losing that partnership will be a challenge.
It will, but Lyft seems confident they can make up for it with new partnerships. Their long-term plan relies on strategic partnerships for continued growth.
So we've covered a lot here: Lyft's financial performance, strategic moves, and future plans. They've had a fantastic year, smashing records and exceeding expectations.
They really have. They're clearly focused on customers, innovation, and efficiency.
They've also shown they can adapt to market changes and build strong partnerships.
Absolutely. But there are challenges ahead like competition and pricing pressure.
It'll be interesting to see how they handle it all.
It will. They've got a clear vision for the future, embracing things like autonomous vehicles and building a robust media business.
Now, stepping back, what does Lyft's performance mean for the rideshare industry overall?
Well, it shows the rideshare market has massive potential. It's changing how we get around cities, and Lyft is proving it can be profitable.
That focus on customers, efficiency, and partnerships has really paid off for them.
It has, and their move into autonomous vehicles shows they're thinking big.
Lyft's not just a rideshare company anymore, they're a tech company shaping the future of transportation.
Exactly.
Their strategy will likely influence the entire industry.
For sure. It's an exciting time to be watching this space.
Now let's talk about the investment angle. Lyft's success has big implications for investors. They've shown they can grow revenue, manage costs, and turn a profit.
They have, and their moves into autonomous vehicles and media are creating new opportunities.
But investors should also remember the risks and challenges. The competition is fierce, and there's that pricing pressure.
Definitely things to consider.
As always, everyone, this is not financial advice.
Right, we're just sharing information to help you make your own informed decisions.
Now, what financial metrics should investors pay attention to?
Well, revenue growth is key. Look at their gross bookings growth, which shows how much business they're doing.
And what about individual rides?
Keep an eye on average revenue per ride. That can fluctuate based on their pricing strategies and the types of rides people are taking.
And of course, profitability is important.
Absolutely. Investors will be looking at both adjusted EBITDA and GAAP net income. Can they generate sustainable profits? That's the question.
Makes sense. Now, let's talk valuation. How much is a company like Lyft worth?
That's a tricky one. Lyft's valuation depends on lots of things: their financial performance, growth potential, their position in the market, and even overall market sentiment.
So no easy answer.
Nope. Investors need to look at all these factors and use different valuation methods like price-to-earnings ratio and price-to-sales ratio.
And comparing them to other companies is important, right?
Exactly. Look at their peers in the rideshare industry and the broader tech sector. It can give you a sense of whether Lyft is priced fairly.
It's an art as much as a science.
It really is. Now, what about risks and challenges for potential investors?
Well, the rideshare industry is very competitive.
It is. Uber's still a big player, and new companies are popping up all the time.
Lyft has to keep innovating to stay ahead of the game.
Right. And then there's that pricing pressure we talked about that could hurt their profits.
And we can't forget about regulations. Those are always changing for rideshare companies.
For sure. Investors need to keep a close eye on these risks and see how Lyft handles them.
All right, we've covered a ton of ground in this deep dive. Lyft had a phenomenal year, hitting record highs and exceeding expectations.
They're definitely a force to be reckoned with.
Their customer focus, efficiency, and partnerships have been key.
Absolutely. And their investment in innovation is impressive. They're expanding their services and pushing the boundaries of what's possible.
Their move into autonomous vehicles is a bold step,
It is. They're not afraid to take risks.
but they also face big challenges. Competition is fierce, and those pricing pressures could hurt.
True, but they've shown they're adaptable.
Investors need to weigh the potential rewards against the risks, right?
Absolutely.
And as always, this is not financial advice. We're just here to provide information and insights.
To help you make your own informed decisions.
Now, before we move on, let's shift gears and have a little fun.
Time for some speculation.
Exactly. What if, and I know this might sound a little crazy, what if Lyft's move into autonomous vehicles makes them a major player in the logistics space?
Interesting. You're thinking a fleet of self-driving delivery vehicles.
Exactly. Zipping around cities, delivering packages and groceries with amazing efficiency.
They already have that partnership with DoorDash, and maybe they could team up with someone like Amazon.
Talk about disruption.
It would be huge. For Lyft, and maybe even for the entire transportation landscape.
Okay, so maybe a bit of a long shot, but
Mm.
it's fun to think about. And remember, everyone, this is all just speculation.
Right. We're just exploring possibilities.
Okay, so that wraps up part one of our Lyft deep dive. We've looked at their financials, their strategies, and their plans for the future.
It's a fascinating company pushing the boundaries in the world of transportation.
We'll be back soon with part two, where we'll dig even deeper into Lyft's performance and explore what it all means for investors.
Stay tuned. All right, so we covered a lot of ground in part one, gave a good overview of Lyft's performance and their plans.
Yeah, we hit the highlights, but there's always more to uncover, right?
Absolutely. Let's dig deeper into some of the finer points. What really stood out to you from this earnings call?
I think their commitment to both rider and driver satisfaction is really impressive. They're not just focusing on one side of the equation.
Yeah, that's a really good point. Some companies just chase growth and forget about the people involved.
Right. And it seems like they genuinely understand that a healthy ecosystem needs both happy riders and happy drivers.
They've said as much, and their actions back it up.
Their efforts to boost driver earnings and provide better support seem to be really resonating.
That 16-point preference gap we talked about is pretty telling. Drivers are voting with their wheels, so to speak.
Exactly. And it's not just about throwing money at the problem either. They're tackling specific pain points that drivers have been complaining about for years.
Yeah, like those breakout situations where a ride takes way longer than expected. They've made sure drivers get compensated fairly for that extra time.
It's those little things that can make a big difference in driver morale.
Little things add up. And they're smart to use technology to make life easier for drivers, too.
Right, like using AI to streamline those support processes so drivers can get help quickly and easily.
Exactly. Frees up their time to focus on driving, which is what they're there to do.
And on the rider side, those investments in demand prediction models and incentive systems are paying off with faster ETAs.
Yeah, they're using data to make sure drivers are in the right place at the right time. That means shorter wait times for riders.
It's a win-win for everyone involved.
Definitely. And of course, we have to talk about their efforts to reduce surge pricing.
That's been a major pain point for riders in the past.
It has. And Lyft seems committed to making prices more stable and predictable.
That price lock feature is a great example.
It is. Riders love knowing exactly how much their ride will cost up front. No surprises.
And now it's available 24/7, so it's even more convenient.
It's those customer-centric features that really set Lyft apart.
Absolutely. So they're doing a lot of things right in terms of the customer experience. But we can't forget about their financial performance. Achieving GAAP profitability is a huge milestone.
It is. Not many companies in this space can say that.
It really shows that they're focused on operational efficiency and keeping costs under control.
They're managing to do that while still investing in growth, which is impressive.
And generating positive free cash flow for the entire year is a sign of real financial strength.
It gives them a lot of options for the future. They can invest in new technologies, expand into new markets, or even make strategic acquisitions.
Speaking of new technologies, their push into autonomous vehicles is really exciting.
It is. It's a bold bet, but the potential payoff is huge.
If they can successfully integrate self-driving cars into their fleet, it could revolutionize their business.
Imagine a world where a big chunk of Lyft's rides are handled by AVs. That would significantly reduce their labor costs.
And potentially open up whole new revenue streams. They could become a major player in logistics and delivery.
Like we were speculating about earlier.
Exactly. Even if the AV revolution takes a little longer to fully materialize, those existing partnerships, like the one with DoorDash, are already showing how Lyft can expand beyond just rides.
They're definitely thinking outside the box.
And let's not forget about their media business. That's still a relatively new venture for them, but it's growing rapidly.
They're projecting some pretty impressive numbers for the next few years.
Their innovative ad formats and captive audience are attracting a lot of interest from advertisers.
It's a smart way to diversify their revenue and build a more resilient business model.
So there are definitely challenges on the horizon, but Lyft seems well equipped to handle them.
They've got a good track record of adapting to change and staying ahead of the curve.
I'm curious to see how they navigate those challenges and what innovative solutions they come up with.
Me too. This is definitely a company to keep an eye on.
Before we move on, though, I want to circle back to something we touched on earlier. Their focus on those higher margin services like Black and SUV rides.
Ah, yes. That's a key part of their strategy.
By catering to a more premium segment of the market, they can boost their average ride value and improve profitability.
And those Black and SUV rides are growing like crazy. Clearly, there's demand for that more luxurious experience.
It shows they understand how to adapt to the changing needs and preferences of their customers.
They're not just a one-size-fits-all rideshare company anymore.
Exactly. They're becoming a multifaceted mobility platform.
Okay, so let's look ahead now. What does their guidance for Q1 2025 tell us?
They're still projecting solid growth, but there are some potential headwinds to keep in mind.
Right, like the pricing pressure we talked about earlier.
They're expecting mid-teens rides growth, but their gross bookings growth is projected to be a bit lower, somewhere between 10% and 14%.
That reflects the reality of the market right now. There's downward pressure on prices across the entire industry.
It's a tough spot for these companies.
Yeah.
They need to stay competitive on price, but also protect their margins.
They've got to find that sweet spot.
And then there's the impact of the Delta partnership ending.
Yeah, that's going to hurt a bit. They're expecting a small dip in rides and gross bookings growth starting in Q2 2025.
But they seem confident they can make up for it with new partnerships.
They're always on the lookout for new opportunities.
It's a fast-moving industry, so staying agile and adaptable is crucial.
Absolutely. They can't afford to stand still for too long.
So lots of moving pieces for Lyft in the coming months. But they've shown that they can handle change and come out stronger on the other side.
I think they're well positioned for the future, but of course, no investment is without risk.
That's why we always emphasize that this is not financial advice.
Right. We're just here to provide information and different perspectives.
So investors need to do their own research, weigh the potential rewards against the risks, and make decisions that align with their own goals and risk tolerance.
That's the responsible way to approach any investment.
Speaking of responsible investing, let's talk about some of the key financial metrics that investors should be paying attention to when evaluating Lyft.
Okay, what should they be watching?
Well, revenue growth is always a good place to start. How quickly are their sales increasing? That tells you something about the demand for their services.
Right. And within that, it's useful to look at their gross bookings growth. It shows the total value of all the rides booked through their platform.
And then there's average revenue per ride.
That can fluctuate based on pricing strategies and the mix of rides people are taking. More premium rides obviously mean higher revenue per ride.
And of course, profitability is crucial. Investors want to see that Lyft can not only generate revenue, but also keep costs under control and turn a profit.
That's where metrics like adjusted EBITDA and GAAP net income come in.
Those give a good indication of their financial health and their ability to generate sustainable profits.
And then there's a big question of valuation. How much is Lyft actually worth?
That's where things get a bit more complex.
It is. Valuation is based on a lot of factors. Their financial performance, their growth potential, their competitive position, and even just the overall mood of the market all play a role.
It's not an exact science.
Definitely not. Investors have to look at all those factors, compare Lyft to other companies in the industry, and ultimately make a judgment call.
Remember, there's no one right answer when it comes to valuation. It's about weighing all the available information and making an informed decision.
Okay, so we've talked about the good stuff. Now let's address the elephant in the room, the risks and challenges that investors need to be aware of.
The rideshare industry is notoriously competitive.
It is. Uber's not going anywhere, and there are always new companies trying to get a piece of the pie.
Lyft has to constantly innovate and find ways to differentiate itself to stay ahead of the game.
Exactly. They can't just rest on their laurels.
And then there's that pricing pressure we talked about earlier. That's a real threat to profitability.
If they have to keep lowering prices to compete, it could eat into their margins.
And we can't forget about the regulatory landscape for rideshare companies. It's constantly changing, and that can create uncertainty and compliance costs.
It's a headache for sure. Investors need to understand how Lyft is approaching these challenges and what strategies they have in place to mitigate the risks.
All right, so we've really dug deep into Lyft's performance this quarter. We've looked at their financials, their strategic moves, their future plans, and the potential risks they face.
It's a complex picture, but overall I'd say they're in a pretty good position.
They've achieved some impressive results, and they seem to be making smart decisions to position themselves for continued growth.
They're a company with a clear vision and a track record of execution.
But as with any investment, there are risks involved.
Always. Investors need to do their due diligence and make sure they understand the company and the industry before putting their money down.
And remember, everyone, this is not financial advice. We're just two people having a conversation and sharing our thoughts and insights.
Exactly. We're not qualified financial advisors, so please don't take anything we say as a recommendation to buy or sell any stock.
Now, before we wrap up this part, I want to have a little fun and indulge in some speculative thinking.
Oh, I love where this is going. Time for some outrageous but plausible trade ideas.
You know it. Remember, everyone, this is purely hypothetical. We're just exploring some interesting scenarios, not giving investment advice.
So let's hear it. What wild idea do you have cooking? Okay, lay it on me. Hit me with your wildest trade idea.
All right, so what if, and I know this might sound crazy, what if Lyft went after a company that's totally different from their core business?
Okay, I'm all ears.
What if they tried to acquire Airbnb?
Airbnb, the vacation rental company.
Wow,
That's out there, but tell me more.
think about it though. Both companies are about connecting people with experiences. Lyft with transportation, Airbnb with places to stay.
Yeah, I see the connection.
They could create a seamless travel experience. Book your flights, your Airbnb, your Lyft rides, all in one place.
A one-stop shop for travel. That's an interesting idea.
Right, and Lyft already has the technology and the logistics expertise to handle it all. Airport pickups, getting around your destination, the whole 9 yards.
They could offer some pretty sweet travel packages, too. Bundle those Airbnb stays with Lyft rides, and boom, you've got a deal.
Imagine landing at your destination and having all your transportation taken care of, no stress.
That would be awesome. And think about the data they could collect.
Right. They could personalize recommendations and offers based on your travel history, your preferences, even your social media activity.
They could suggest local spots, restaurants, things to do that match your interests.
A totally customized travel experience. That's the future.
It would be pretty amazing, and it would give Lyft a huge advantage in the travel market, which is already booming.
It's a bold move, no doubt,
But,
but it could be a game changer.
of course, merging two massive companies like that wouldn't be easy. There would be tons of challenges.
Yeah, integrating those platforms, dealing with regulations, it wouldn't be a walk in the park.
But hey, stranger things have happened in the tech world.
Exactly. So that's our outrageous but plausible trade idea for today. Lyft buys Airbnb.
I like it. Bold, ambitious, and who knows, maybe it'll actually happen someday.
All right, everyone, remember, this is all just hypothetical. Not financial advice, just some fun speculation.
We're just exploring the possibilities, stretching our imaginations a bit.
It's good to think outside the box sometimes and consider what the future might hold.
Exactly. You never know what crazy ideas might actually come true.
Well, that wraps up another episode of Talk Tickers. We had a blast diving deep into Lyft's Q4 2024 earnings call. We explored their financials, their strategies, their plans for the future, and even some wild trade ideas.
It's been a great conversation. Lyft is such a fascinating company. They're really at the forefront of innovation in the transportation space.
They've achieved some impressive results, but they're also facing some big challenges. It'll be interesting to see how they navigate the road ahead.
I agree. They've got a lot of potential, but the competition is fierce. They'll need to stay on top of their game to maintain their momentum.
And as always, we want to remind everyone that this is not financial advice. We're not experts, just enthusiasts who love to talk about companies and markets.
So please do your own research, consult with a qualified financial advisor, and make informed decisions based on your own individual circumstances.
We hope you've enjoyed this deep dive into Lyft's world. And as always, thanks for listening.
See you next time.